risk management, comprehensive solutions for managing and mitigating financial risks. Risk management involves the provision of a wide range of financial instruments and services aimed at effectively managing and mitigating risks associated with financial transactions and investments. This proactive approach enables individuals and organizations to identify, assess, and address potential risks to their financial well-being. Financial risks arise from a multitude of factors, such as market volatility, economic uncertainties, regulatory changes, and operational vulnerabilities. To navigate these challenges successfully, individuals and businesses rely on risk management solutions to safeguard their assets, optimize returns, and protect against potential losses. The role of risk management extends beyond simply identifying risks. It also involves implementing strategies to minimize their impact. This entails the careful analysis and evaluation of potential risks, followed by the development of appropriate risk mitigation strategies tailored to specific circumstances. Financial institutions and professionals offering risk management services provide expertise in assessing risk exposure and designing risk management frameworks. They offer a range of financial instruments, such as insurance products, hedging strategies, diversification techniques, and derivatives, to help clients protect their investments and assets from adverse market conditions. Moreover, risk management services assist clients in making informed decisions by providing insights and recommendations based on thorough risk assessments. This comprehensive approach ensures that potential risks are identified, quantified, and managed in a manner aligned with the client's risk appetite and financial objectives. By employing risk management techniques, individuals and businesses can proactively address potential threats to their financial stability. This approach helps enhance financial resilience, protect against market downturns, and optimize risk-adjusted returns. Ultimately, the goal of risk management is to enable individuals and organizations to navigate the complex financial landscape with confidence and peace of mind. Payment system, facilitating efficient fund transfers and financial transaction settlement. A payment system plays a vital role in facilitating the smooth and secure transfer of funds and the settlement of financial transactions. It encompasses various mechanisms and infrastructure that enable individuals, businesses, and financial institutions to conduct transactions efficiently. Efficient fund transfers are crucial in today's interconnected world, where individuals and businesses engage in a wide range of financial activities. Whether it's paying for goods and services, transferring money to family and friends, or conducting large-scale business transactions, a robust payment system ensures that these transactions can take place seamlessly. The infrastructure supporting a payment system consists of various components, including payment networks, clearinghouses, settlement systems, and electronic funds transfer systems. These components work together to enable the movement of funds from one party to another securely and swiftly. Payment networks provide the necessary connectivity between different participants, such as banks, payment processors, and merchants. They establish the framework for transmitting payment instructions and ensuring the authentication and authorization of transactions. Clearinghouses play a critical role in the payment system by acting as intermediaries between the parties involved in a transaction. They validate and verify the transactions, reconcile accounts, and ensure that the funds are available for settlement. Settlement systems are responsible for the final step in the payment process, which involves the actual transfer of funds from the payer to the payee. These systems ensure that the funds are securely and accurately transferred, and the relevant accounts are appropriately updated to reflect the completed transaction. Electronic funds transfer systems, such as automated clearinghouse (ACH) systems and real-time gross settlement (RTGS) systems, provide the technical infrastructure for the electronic transfer of funds. They enable the movement of money between different financial institutions and support various payment instruments, including credit cards, debit cards, bank transfers, and digital wallets. The efficiency and reliability of a payment system are of utmost importance. A well-functioning payment system reduces transaction costs, minimizes settlement risk, and enhances overall financial stability. It also promotes economic growth by facilitating commerce, trade, and financial inclusion. In summary, a robust payment system provides the necessary mechanisms and infrastructure to facilitate the efficient transfer of funds and settlement of financial transactions. By ensuring secure and seamless transactions, it contributes to the smooth functioning of the economy and supports individuals and businesses in conducting their financial activities effectively. Financial market operations, facilitating the trading and exchange of diverse financial assets. Financial market operations encompass the essential processes and activities that enable individuals, institutions, and investors to buy and sell a wide range of financial assets, including stocks, bonds, and derivatives. These operations create a dynamic marketplace where participants can transact, allocate capital, and manage their investment portfolios. The buying and selling of financial assets in the financial markets are facilitated through various platforms and exchanges. These platforms provide the necessary infrastructure, rules, and regulations for market participants to interact and execute their transactions efficiently. 1. Stock markets. Stock markets, also known as equity markets, facilitate the trading of company stocks or shares. Companies issue shares to raise capital, and investors can buy and sell these shares in the stock market. Stock exchanges, such as the New York Stock Exchange, NYSE, or NASDAQ, provide the centralized marketplace where buyers and sellers can come together to trade shares. 2. Bond markets. Bond markets enable the issuance and trading of debt securities, such as government bonds, corporate bonds, and municipal bonds. These markets allow governments, corporations, and municipalities to raise funds by issuing bonds, which are then bought and sold by investors. Bond markets provide a platform for investors to invest in fixed income securities and earn interest over a specified period. 3. Derivatives markets. Derivatives markets facilitate the trading of financial instruments derived from underlying assets. These instruments include options, futures, swaps, and forward contracts. Derivatives provide market participants with tools for risk management, speculation, and hedging. They allow investors to gain exposure to various asset classes and manage their portfolio's risk and return characteristics. The operations within financial markets involve various participants, including individual investors, institutional investors, brokerage firms, and market makers. Market participants rely on market intermediaries, such as brokers and dealers, to execute their trades, provide liquidity, and ensure the smooth functioning of the markets. Efficient financial market operations are vital for the allocation of capital and the determination of asset prices. These operations promote transparency, price discovery, and fair market competition. They also foster liquidity, enabling investors to enter and exit positions with relative ease. Financial market operations are subject to regulatory oversight to maintain market integrity, protect investors, and ensure fair practices. Regulatory bodies, such as the Securities and Exchange Commission, SEC, in the United States, establish rules and regulations to promote market stability, prevent market manipulation, and enforce disclosure requirements. Overall, financial market operations form the backbone of the global financial system. They enable the exchange of diverse financial assets, providing opportunities for investment, risk management, and capital allocation. By facilitating efficient trading and price discovery, these operations contribute to the functioning and growth of economies worldwide. Financial regulation, upholding stability and integrity in the financial system through rule enforcement. Financial regulation plays a crucial role in maintaining the stability and integrity of the financial system by enforcing a set of rules and regulations. These regulations are designed to safeguard the interests of investors, promote fair practices, and mitigate systemic risks within the financial industry. 1. Protecting investors. Financial regulations aim to protect individual and institutional investors from fraudulent activities, misrepresentation, and market manipulation. They establish standards for transparency and disclosure, ensuring that investors have access to accurate and timely information about the financial products and services they engage with. Additionally, regulations often require financial professionals and institutions to adhere to strict codes of conduct and ethical practices when dealing with clients' investments. 2. Ensuring market integrity. Regulations promote fair and transparent market practices by prohibiting insider trading, market manipulation, and other fraudulent activities. By maintaining market integrity, financial regulations foster trust and confidence in the financial system, encouraging participation from a wide range of market participants. This trust is essential for the efficient functioning of markets, as it encourages investment and reduces information asymmetry. 3. Mitigating systemic risks. Financial regulations address systemic risks that could threaten the stability of the entire financial system. They establish frameworks for capital adequacy, risk management, and liquidity requirements to ensure that financial institutions are well prepared to weather economic downturns. These regulations also provide mechanisms for monitoring and supervising financial institutions to detect and address potential risks before they escalate. 4. Supervising financial institutions. Regulatory bodies oversee and supervise financial institutions to ensure compliance with established rules and regulations. They conduct regular examinations, audits, and stress tests to assess the financial health and stability of institutions, thereby mitigating potential risks. By monitoring the activities of banks, insurance companies, investment firms, and other financial entities, regulators can intervene if necessary to protect the overall financial system. 5. Promoting financial inclusion and consumer protection. Financial regulations often aim to promote financial inclusion, ensuring that individuals and businesses have access to essential financial services. They encourage responsible lending practices, discourage discriminatory practices, and establish consumer protection mechanisms. These regulations help prevent predatory practices and ensure that financial services are accessible and suitable for a diverse range of consumers. Financial regulations are typically enforced by dedicated regulatory authorities or government agencies responsible for overseeing the financial sector. These agencies have the authority to issue licenses, impose penalties for non-compliance, and enforce regulations through investigations and legal actions. Effective financial regulation is essential for maintaining market stability, protecting investors, and fostering confidence in the financial system. By upholding standards of fairness, transparency, and accountability, regulations provide a robust framework that supports sustainable economic growth and development. The informal sector, unregulated economic activities operating beyond formal business norms. The informal sector encompasses a wide range of economic activities that operate outside official regulations and conventional business practices. These activities occur beyond the purview of formal business transactions, often lacking official oversight and adherence to established norms. Key components of the informal sector include street vending, small-scale informal businesses, and informal lending arrangements. 1. Nature of informal sector activities. The informal sector encompasses a diverse array of economic activities that are typically self-employed or carried out in small-scale settings. Street vending, for instance, involves the sale of goods or services on the streets, sidewalks, or public spaces without formal business registrations. Small-scale informal businesses refer to enterprises that operate without legal recognition or compliance with regulatory requirements. Additionally, informal lending arrangements involve the provision of loans outside formal financial institutions, often through personal connections or community-based networks. 2. Distinction from the formal sector. The informal sector operates separately from the formal financial sector, which encompasses regulated businesses and transactions within established legal frameworks. While the formal sector adheres to rules and regulations enforced by governmental authorities, the informal sector operates in a more unregulated environment, where participants often bypass official requirements and frameworks. 3. Limited access to formal financial services. One of the defining characteristics of the informal sector is its limited access to formal financial services and institutions. Informal workers and businesses often lack access to banking services, credit facilities, and insurance offered by regulated financial institutions. This limited access can hinder their ability to save, invest, and protect against financial risks. As a result, informal workers and businesses heavily rely on cash transactions, personal savings, and informal lending networks to manage their financial needs. The informal sector's informal lending networks, often prevalent within communities, provide alternative means of accessing credit for individuals and small businesses. However, such arrangements can be risky, as they often lack formal contracts, collateral, and legal protections. Consequently, participants in informal lending arrangements may face higher interest rates and greater vulnerability to exploitation or default. 4. Implications and policy considerations. Understanding the informal sector is crucial for policymakers, as it represents a significant portion of economic activity in many countries. It serves as a source of employment and income generation for a large number of individuals, particularly in developing economies. Policymakers must recognize the unique challenges faced by the informal sector and develop targeted strategies to enhance its integration with the formal economy. Efforts to bridge the gap between the informal and formal sectors often involve expanding financial inclusion initiatives, promoting financial literacy, and providing accessible financial services tailored to the specific needs of informal workers and businesses. These initiatives can help improve access to savings accounts, microfinance services, and insurance products, enabling informal participants to manage their finances more effectively and mitigate risks. In summary, the informal sector encompasses economic activities that operate outside formal regulations and established business norms. Its informal nature leads to limited access to formal financial services and institutions. Policymakers and stakeholders should strive to address the unique challenges faced by the informal sector, aiming to promote financial inclusion, enhance economic opportunities, and foster greater integration with the formal economy. Money, a widely accepted medium of exchange, measure of value, and store of wealth. Money can be defined as an item that holds widespread acceptance and is considered suitable for use as a medium of exchange in transactions involving goods and services. It serves as a common measure of value and provides a means for storing wealth. Money takes on diverse forms, including physical currency in the form of coins and banknotes, demand deposits held in banks, and electronic or digital payment methods. 1. Medium of exchange. Money functions as a medium of exchange, facilitating transactions by serving as an accepted intermediary between buyers and sellers. It eliminates the need for direct barter, where goods and services are exchanged directly for other goods and services, by providing a universally accepted means of trade. Money simplifies the process of transactions, enhancing economic efficiency and promoting economic growth. 2. Measure of value. Money serves as a measure of value, allowing individuals and businesses to assess and compare the worth of different goods and services. It provides a standardized unit of account, enabling consistent valuation across various economic activities. By assigning prices to goods and services, money facilitates meaningful comparisons, calculations, and economic decision-making. 3. Store of wealth. Money also functions as a store of wealth, allowing individuals and businesses to save and accumulate assets over time. Money's durability and stability make it a reliable repository of value. Rather than immediately spending all earnings, individuals can choose to save money for future expenses or investment opportunities. By preserving purchasing power, money helps maintain the value of wealth across time. 4. Forms of money. Money can take various forms to fulfill its role in economic transactions. Physical currency, including coins and banknotes, has traditionally been a tangible representation of money. Demand deposits held in banks, commonly known as checking or current accounts, provide convenient access to money through electronic transactions and withdrawals. Additionally, electronic or digital payment methods, such as online transfers, mobile wallets, and cryptocurrencies, have gained prominence in the modern era, offering secure and efficient alternatives to physical currency. The evolution of money has been driven by advancements in technology, increasing financial innovation, and changing societal preferences. While physical currency remains widely used, digital payment methods have gained popularity due to their convenience and accessibility. It's important to note that the value of money relies on public trust and confidence in its acceptability and stability. Central banks and monetary authorities play a crucial role in maintaining the stability of money by regulating its supply, managing inflation, and ensuring the integrity of the financial system. In conclusion, money serves as a widely accepted medium of exchange, a measure of value, and a store of wealth. It takes various forms, including physical currency, demand deposits, and electronic or digital payment methods. By fulfilling these functions, money facilitates economic transactions, enables effective valuation, and supports long-term financial planning. The evolution of money, from bartering to a universally accepted medium of exchange. Throughout history, the concept of money has undergone significant evolution. Before the introduction of money, people relied on a system called bartering, which involved the direct exchange of goods and services without the use of a standardized medium of exchange. However, the development of money marked a significant advancement in economic transactions by simplifying trade through the introduction of a universally accepted medium of exchange. 1. Bartering. Before the emergence of money, bartering was the primary method of trade. Bartering involved individuals directly exchanging goods and services based on mutual needs and preferences. For example, a farmer might trade their crops for clothing made by a tailor. While bartering facilitated basic trade, it had several limitations. It required a double coincidence of wants, meaning both parties had to desire each other's goods or services. Additionally, it posed challenges when trying to establish fair exchange rates and value comparisons between different items. 2. The emergence of money. The development of money represented a significant milestone in the evolution of trade. Money served as a standardized and universally accepted medium of exchange, overcoming the limitations of bartering. It simplified transactions by providing a common measure of value that facilitated the exchange of goods and services. With money, individuals could sell their goods or services for a universally accepted unit of value, enabling greater efficiency and convenience in trade. 3. Functions of money. Money performs several key functions in an economy. It serves as a medium of exchange, eliminating the need for direct barter and facilitating the smooth flow of transactions. Money also functions as a unit of account, providing a standardized measure of value that enables pricing, valuation, and comparison of goods and services. Additionally, money serves as a store of value, allowing individuals to save wealth for future use and investment. 4. Forms of money. Throughout history, money has taken various forms. Initially, commodity money emerged, where valuable items with intrinsic worth, such as gold or silver, were used as money. These items held value in and of themselves and were widely accepted in trade. As economies grew, representative money emerged, where paper or other tokens represented a specific value of precious metals stored in banks. Eventually, representative money evolved into fiat money, which has value based on government decree and public trust in its acceptance. 5. Modern monetary systems. In modern economies, money exists in both physical and digital forms. Physical currency, such as coins and banknotes, remains widely used for in-person transactions. However, the rise of digitalization has led to the emergence of electronic money, including debit and credit cards, mobile payments, and cryptocurrencies. These digital forms of money offer convenience, speed, and security in financial transactions, further advancing the evolution of money. The concept of money has played a vital role in shaping economic systems and facilitating trade throughout history. From the limitations of bartering to the introduction of a universally accepted medium of exchange, the evolution of money has transformed the way societies conduct transactions and allocate resources. As technology continues to advance, the future of money is likely to witness further innovation, with digital and decentralized forms of money gaining prominence. Functions of money. facilitating economic transactions and beyond. Money serves four primary functions within an economy, playing a crucial role in facilitating economic transactions and providing a foundation for financial systems. These functions of money encompass its essential roles as a medium of exchange, unit of account, store of value, and standard of deferred payment. 1. Medium of exchange. One of the fundamental functions of money is to serve as a medium of exchange. Money acts as an accepted and universally recognized intermediary in transactions, enabling the buying and selling of goods and services. Rather than relying on bartering or direct exchange, individuals and businesses can use money to easily facilitate transactions, simplifying trade and promoting economic efficiency. The medium of exchange function is particularly significant as it eliminates the need for a double coincidence of wants. Parties involved in a transaction can now accept money as payment, confident in its future acceptance by others in future transactions. This widespread acceptance of money as a medium of exchange promotes liquidity, enables specialization, and fosters economic growth. 2. Unit of account. Money also functions as a unit of account, providing a standardized measure of value for goods, services, and assets. It allows for consistent valuation and comparison, as prices are expressed in terms of a common monetary unit. By assigning prices to various goods and services, money facilitates meaningful economic calculations, price comparisons, and accurate record-keeping. The unit of account function enables individuals, businesses, and governments to measure and track economic activities, assess profitability, make informed financial decisions, and allocate resources efficiently. It helps establish a framework for evaluating economic performance and understanding the relative worth of different goods and services within an economy. 3. Store of value. As a store of value, money allows individuals and businesses to save wealth and retain purchasing power over time. Money's durability, divisibility, and relative stability make it a reliable repository for storing wealth. By holding money, individuals can defer consumption and accumulate savings for future needs, investments, or unforeseen contingencies. While money itself may not generate direct returns or interest, it serves as a means to preserve value and maintain liquidity. Money's function as a store of value empowers individuals to manage their finances, plan for the future, and protect against inflationary pressures or economic uncertainties. 4. Standard of deferred payment. Money acts as a standard of deferred payment, allowing for the settlement of debts and obligations over time. It provides a reliable unit of account for assessing and fulfilling contractual agreements that involve deferred payment terms, such as loans, mortgages, and credit transactions. The standard of deferred payment function ensures that parties involved in financial transactions can honor their commitments in the agreed-upon monetary terms. This function relies on the stability and wide acceptance of money as a trusted means of settlement, bolstering confidence in the financial system and promoting economic stability. By performing these four functions, money serves as an essential pillar of modern economies, facilitating economic transactions, providing a foundation for financial systems, and promoting economic stability. The continued evolution of money, including the rise of digital currencies and innovations in payment technologies, further reinforces its crucial role in shaping economic activity. Medium of exchange, facilitating transactions and overcoming bartering challenges. The function of money as a medium of exchange plays a crucial role in economic transactions by providing a widely accepted means of facilitating the purchase of goods and services. It serves as a powerful tool that eliminates the complexities and limitations associated with bartering, thereby promoting efficient trade and economic growth. Bartering, the direct exchange of goods and services, posed significant challenges. It required a double coincidence of wants, meaning that both parties had to possess something the other desired in order to trade. This requirement often led to inefficiencies, as finding a suitable trading partner with mutually desired goods or services could be time-consuming and impractical. Money, as a medium of exchange, revolutionized the way people transact by providing a universally accepted medium that is readily exchangeable for goods and services. Its acceptance by a broad range of market participants establishes trust and confidence, enabling seamless transactions even between strangers or parties with differing needs. When engaging in transactions using money, individuals and businesses can easily trade their goods or services for a recognized unit of value, typically in the form of currency. By accepting money as payment, sellers are assured of its future acceptance by others in subsequent transactions. This acceptability of money significantly enhances the liquidity and efficiency of economic exchanges. Moreover, money as a medium of exchange promotes specialization and division of labor. It enables individuals and businesses to focus on producing goods or providing services in which they have a comparative advantage, knowing that they can exchange their products for money and use it to obtain other desired goods or services. This specialization enhances productivity, as individuals can dedicate their time and resources to activities they excel in, leading to overall economic growth. The use of money as a medium of exchange also simplifies the valuation and comparison of goods and services. It provides a standardized unit of account that allows for consistent pricing and accurate record keeping. Prices expressed in monetary terms enable individuals, businesses, and governments to measure economic activities, track profitability, and make informed financial decisions. In summary, money's function as a widely accepted medium of exchange revolutionizes economic transactions by overcoming the challenges associated with bartering. By facilitating the purchase of goods and services, money enhances trade efficiency, promotes specialization, and simplifies economic calculations. As an essential element of modern economies, the medium of exchange function of money plays a fundamental role in driving economic activity and fostering prosperity. Unit of account, establishing a standard measure for valuation and comparison. The function of money as a unit of account serves as a vital pillar in economic systems by providing a standardized measure of value. This function enables the comparison and valuation of different goods and services, facilitating economic calculations, trade, and informed decision-making. Money's role as a unit of account allows for a common language of value within an economy. It provides a standardized unit in which prices are expressed, making it possible to assign numerical values to goods, services, and assets. By assigning monetary values, money establishes a framework that allows for meaningful comparisons, evaluations, and assessments of economic activities. The unit of account function of money simplifies economic calculations and facilitates price comparisons. It enables individuals, businesses, and governments to measure and track economic performance, assess profitability, and allocate resources efficiently. With money serving as a common measure, individuals can easily determine the relative worth of different goods and services, aiding in decision-making processes. Furthermore, money as a unit of account allows for consistent valuation across various economic transactions. It helps in the pricing of goods and services, determining wages, setting rent and interest rates, and evaluating the value of assets. This standardized valuation is especially crucial in complex economies where diverse products and services are traded. The unit of account function also provides a basis for record keeping and financial reporting. Businesses utilize money as a common measure to track revenue, expenses, and profits, facilitating accurate accounting and financial management. Government entities rely on money as a unit of account to assess tax obligations, measure economic growth, and formulate fiscal policies. Moreover, money's function as a unit of account helps individuals and businesses make informed financial decisions. It allows for clear comparisons of costs, prices, and returns on investment. By expressing values in monetary terms, individuals can assess the relative worth and prioritize their spending and saving decisions accordingly. It's important to note that the unit of account function relies on the stability and credibility of money as a trusted measure of value. Stable currencies with low inflation rates provide a reliable and consistent unit of account, enabling accurate comparisons over time. In summary, money's function as a unit of account establishes a standard measure of value that allows for the comparison and valuation of goods, services, and assets within an economy. It simplifies economic calculations, facilitates price comparisons, aids in decision-making, and promotes efficient resource allocation. As an essential component of modern economies, the unit of account function of money plays a crucial role in fostering economic transparency, evaluation, and growth. Store of value, preserving wealth and financial planning. One of the key functions of money is serving as a store of value, allowing individuals and businesses to preserve their wealth and assets for future use or investment. Money's durability, stability, and widespread acceptance make it a reliable instrument for storing value over time. As a store of value, money offers individuals the opportunity to defer consumption and save wealth for future needs or goals. Rather than immediately spending all earnings, money can be set aside and accumulated over time, providing a buffer for unforeseen contingencies and future financial objectives. Money's durability plays a crucial role in its function as a store of value. Physical currency, such as coins and banknotes, can be stored securely for extended periods without significant loss or degradation. This durability ensures that the stored value remains intact and accessible when needed. Additionally, money's stability, especially in comparison to other goods or assets, contributes to its effectiveness as a store of value. While the value of goods and certain assets may fluctuate over time due to market conditions, changes in demand, or other factors, money maintains a relatively stable purchasing power. This stability allows individuals to preserve the value of their wealth over time, safeguarding against inflation or erosion of purchasing power. The widespread acceptance of money further enhances its function as a store of value. Money, in its various forms, is universally recognized and accepted as a medium of exchange, making it highly liquid and easily convertible into goods, services, or other assets when needed. This liquidity ensures that stored value can be readily accessed and utilized without significant obstacles or delays. Money's role as a store of value supports financial planning and long-term wealth management. By saving and accumulating money, individuals can pursue various financial objectives, such as education, homeownership, retirement, or investment opportunities.